Hi, my name is Stuart and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. If there's one thing that's been present in property for as long as I've been in this business, nearly 25 years, is that it's always been expensive. So what I wanted to do today is talk about if our budget is making or forcing us to make some trade-offs or compromise, then maybe a value add strategy is something that we need to consider. And that's what I want to talk about today. I'm going to talk about what does that mean, how to implement it, what are the financial implications, and so on and so forth. But as I said, there's always articles and commentary around housing affordability that, property is expensive, how are people going to get in and be able to buy property? It's becoming less and less affordable, all those sorts of things. The news is, though, that the story hasn't really changed. There was those sorts of articles and commentary around 25 years ago when I started this business, and they haven't really changed. Now, of course, property is more expensive than it was back then, but the affordability of property, or the seeming affordability, hasn't really ever changed. So that is, property's always been expensive, and it's always seemed expensive, and it's always seemed difficult to get on the property ladder. But once you're on the property ladder, you can use that equity and leverage that equity and use it to build wealth. Now, the problem, though, is for people that are starting out, either if you're a first-time investor or you're a first-time property buyer, you're going to have this tension between how much property do you get for your budget versus how much quality do you get for your budget. And so quite often people are then comparing, do I invest or buy a smaller property that's in a blue chip suburb, or do I move to an adjoining suburb or even outlying suburb in order to get a house or a villa unit or something more for my money compared to, say, a 2-bedroom apartment in a investment grade location. And I think first time buyers probably face this dilemma or trade-off more so than anyone else, but certainly first time investors do as well. And this is where I think a value add strategy works really well, and something that people need to really think about, that if they don't have an unlimited budget, of course everyone has a limited budget, but a budget that doesn't force them to make too many compromises, then this is where this value add strategy comes into play. So essentially, if you become a value-added investor, you're going to allocate some of your financial budget to improving the property after you purchase it. So in other words, a value-add investor is willing to make an initial compromise on the quality of the dwelling that they're buying and maybe the size of the dwelling that they're buying. And even if they're an investor, that means taking a haircut on terms of the amount of rental income they're going to get in return for getting a better quality location. So really allocating a lot of their budget towards buying the underlying land value and preserving some of their budget to improve the asset after the fact. Now, we really know that and I've spoken many times in this podcast, that the true value of investing in property is the compounding impact of the capital growth, because property provides most of its overall return in capital growth and relatively little of its overall return in income, net income, particularly after expenses. It's that compounding nature of growth that really does all the heavy lifting. So if you have an average growth rate, and I say average growth rate over a very long period of time, we know that growth isn't uniform. It's not straight line. It's not going to happen every year. But if you have an average growth rate of 7.2% per annum over a very long period of time, on average, your property should double in value every 10 years. That means if we buy $1 million property today, in 30 years' time, it would have doubled 3 times and it would be worth $8 million. So that property then, or the market, has generated $7 million of equity in that property. It's hard to get your head around, and human beings are hardwired not to deal with these compounding numbers very well. But you can just look back in history and you look at average capital growth rates over a 40-year, 45-year period, they're in line with that sort of level. And that's just the median house price as well. That's not without having regard to investment grade characteristics. So the thing to know, though, okay, you've accumulated $7 million over a 30-year period. It's a long time, right? You don't want to wait 30 years to be independently wealthy, and most people don't. I get that. That's not the point. The point is to understand the distribution of that growth. So in the last 10 years, 60% of that $7 million equity occurred, and only 15% occurred in the first decade. So it really does show the critical principle to grasp is this compounding capital growth. And the growth is largely driven by the underlying land value, not the dwelling. So we can't kid ourselves into thinking that some value add strategy is going to outperform a pure long-term growth strategy. It's not. But hopefully the two can kind of complement each other, that you don't need to make fewer compromises if you're just focusing on the land value initially, and then you can try and add value to the property down the track. So how could this work, or how can it help? Well, I've spoken about property cycles before, and broadly, markets tend to move between two cycles, a flat cycle and a growth cycle. Hopefully the idea is to buy just before a growth cycle, at least in the first couple of years of it. And if you do that, you're likely to enjoy above average capital growth rates. So you're not going to get 7%, you might get 10 or 12% over the first sort of 5 to 7 years of owning that property, and you're off to the races. It gives you, puts you in a great position. And if the market is doing all the heavy lifting because it's a growth cycle, that's a fantastic outcome. Of course, over multi-decade periods, the idea is to own an investment grade asset that outperforms the median. So what you really want to do is maximize the average growth rate over a 30-year period. You're not trying to buy a property just to maximize the growth rate over the next 5 years, because that's a false sense of economy. It's just not going to do all that heavy lifting. The advantage of a value add strategy is that it's going to help you create equity in the property regardless of what's happening in the market. And so, especially if your budget has forced you to invest in a location that's not considered pure blue chip, it's possible that in a growth cycle, that location won't enjoy the full kind of upswing of a positive market. So by employing a value add strategy, you're adding a second component of an element that's going to push the value of your property forward and increase the amount of capital equity that you have in that property. And that can give you more flexibility in the short term as well. So for example, if you buy a property today with a value add strategy, you implement that value add strategy, that creates equity in the property. Potentially, if your financial situation or personal situation has changed a lot, say in 5 years' time, and you're faced with the decision, well, maybe I sell the property, take the equity out and put it somewhere else, or use my borrowing capacity in a better way. And I've often seen this happen, for example, where people make a financial decision that's in their best interest and they do as best as they can. But then in 5 years' time, their financial position is wildly different. Their income's increased, they've received inheritance, whatever, their borrowing capacity's dramatically changed. Whatever it is, they're in a much better position. And in that situation, if you've employed a value add strategy, you've hopefully created more growth than what the market has delivered. And therefore, if you need to sell the property after 5 years, which, we try to avoid doing that, of course, because of the nature of compounding capital growth, you get rewarded for holding onto a property for 30 or 40 years, not selling after 5. But sometimes circumstantially, it is the best thing to do. And in that case, you can sell the property in 5 years, and the chances of you walking away with money in your pocket after all the costs are very high. So the value add strategy, I think, opens up more financial options down the track. Whereas if you don't employ that strategy, and let's say the market is done okay over 5 years, but it hasn't shot the lights out, you might be more reluctant to divest of that property if you're not going to make any significant gain. So what does a value add strategy involve, and what sort of improvements are we going to make? Well, the idea is get the greatest financial return for your investment. That's the idea behind a value add strategy. So in practice, this typically means making improvements that are going to improve the property's value by more than the cost of the improvements itself. And so that's why cosmetic work tends to be the focus of this strategy. Notwithstanding, you improving the overall value of the property. So I spend $20,000 on it, and my property's worth $50,000 more, but also it's going to improve the rental income. So, before the improvements, I might be getting $500, and after the improvements, I might be able to get $530 a week, for instance. So not only is the value increasing, but hopefully it improves the cash flow. Now, the type of cosmetic improvements that, probably add the most amount of value are improving the kitchen and bathroom. Now, that doesn't need to be a full renovation, like rip it out and start again. It can be just a cosmetic improvement. You might replace the cupboards, for example, and replace the the appliances in a kitchen, but it's really just bringing up to speed, and they tend to really add a lot of value, as well as updating flooring where it's could be rip the carpets out, polish the floorboards, or it could be, replace the carpet, particularly in bedrooms, those sorts of things. Window furnishing, putting new blinds or awnings on the outside. Painting can have a dramatic impact on the presentation of a property, and adding efficient heating and cooling as well. Particularly, if you're up north, you certainly want some cooling. Well, I'd argue you want cooling and heating in any property anywhere in Australia. In some cases, structural changes like adding a third bedroom, like if you've got a 2-bedroom home and you can add a third bedroom at the back, that can materially enhance the value as well. Now, you've got to be careful though. So I would try and avoid structural works because they tend to involve a higher budget and also greater risk and complexity. But sometimes they can be an attractive thing to do. So the common examples is sort of purchasing a property that is in sound rentable condition, but is in clearly need of upgrade. So that's what I'm talking about, is maybe a property in its original condition. So it's still okay, it's still livable, but it really does need a little bit of love in terms of kitchen, bathroom, flooring, paintwork, window furnishings, and those sorts of things. In that scenario, or this scenario, an investor can go and rent that property. And of course, yes, the rental yield's going to be relatively low. So they will take a haircut on the income side of things, but at least they're put in a position where they can make improvements at some point down the track when their financial position allows them to do so. And at worst case, they can make the improvements just before they sell the asset in order to enhance its value. Now, there's some additional advantages of this strategy as well, in addition to obviously enhancing the value of the asset, creating equity, and also increasing its income. Firstly, you're going to probably have a lower risk of vacancy, and the duration of vacancy is going to be lower as well. So once you renovate a property and it's in really attractive condition, you're probably not going to have any problem finding tenants, particularly in today's market, where in many locations, the vacancy rate's under 1%. But that can be a really good appeal. Not only are you going to get a higher rental income, but really vacancy can be less than a day in a really good asset. I've certainly experienced that from my property investments as well. And secondly, it's going to be a far more marketable property. So not only will you hopefully achieve a better sales price, or it's worth more, but there's going to be fewer barriers to entry or barriers for buyers to deal with. Every property has imperfections, and it's not until you sell the property do you learn about all the imperfections, because potential buyers think about all the reasons that they don't like the property and they talk to the agent about it and so forth. And so the role of a great agent and an educated vendor is to try and minimize or mitigate as many of these objections as possible. Now, a lot of buyers just don't want a renovation project. So by presenting a fully renovated property to the market really widens the pool of potential buyers. And that's certainly been true, say, over the last 5 years when, construction costs were getting out of control during COVID. No one really wanted to take on a renovation project. And just speak to anyone that has completed a renovation project during the last 5 years. They'll tell you, why you wouldn't want to take on such a project. So therefore, what it means then, you're going to have a far more marketable property, and it's likely you will enjoy a relatively quick sale should you need to sell the asset, notwithstanding you've improved its value and income profile, as I said. Now, what I want to talk about next is the best way to implement this strategy, because, one of the challenges with property investing is it tends to be what's a lot more hands-on than, say, investing in ETFs in the share market, for instance. And not all of us have an abundance of time to spend or desire to spend on managing property investments. So I think the best way to implement this strategy is to work with a trusted buyer's agent, someone that's been around for a long time and someone that's helped clients implement this kind of value add strategy in the past. Now, what you'll find typically is that buyer's agents that have been around for a decade or longer will typically work with their existing investors, and they'll find ways to help these investors maximize value. And so, for example, if they bought a property for someone 10 years ago, they might be talking to them about making some cosmetic improvements to that asset, because obviously we all know the property does need maintenance and you need to keep it up to sort of marketable level. And so if you own a property for a long time, eventually you've got to do some improvements to it. And so they would have built up a network of trusted professionals, tradies and so forth, that they can use that will cost effectively and efficiently complete that work. And efficiently is really important too, by the way, because of course, if you're completing some improvements in a property, it's going to be vacant during that period of time. There's an opportunity cost associated with that. So not only we're working with a trusted buyer's agent, not only can they help you buy the, high quality underlying assets, that initial purchase, but the other benefit is that you get access to their network of trusted professionals. And I think this is really important. And it's important for people to understand, because typically, if you've been in business for a long time, you will work with people that are like-minded to you. So if you like to look after your clients, if you like to deliver as much value as possible, if you're ethical, if you want to do things the right way, all those sorts, if that's your sort of mindset, you will find like-minded people just like you to help your clients. And it's very true. I can say at Pro Solution, we work with some great lawyers and some great buyers agents and people that are going to do a really good job. They're going to put their clients first, that are going to look to add value rather than sell a product. All those sorts of things, they're the key things. And typically, we wouldn't work with someone if they weren't like that, because we're like that. Of course, it adds value to the network. And so I think people need to understand that this can be a really good value added thing. Like, for example, our clients get access to our network of professionals, which means that, we've tried and tested these people. We know, we've seen their work before. We know what they know. We know that they're good at what they do. And that's one of the added advantages of working with a buyer's agent, is you get those local people that are going to be able to help you complete these improvements to your property. And just as a side note, I think this sort of highlights why a lot of financial decisions are who questions, not what questions. Quite often we think we need to solve the complex problem ourselves, but sometimes a simple solution, like let's find the right person that can help me answer that, is a better approach. And that's why I call them who decisions, because it should be, who do I ask? Who can I trust to give me the right answer? Who has traveled this road before? Who has done this before and made mistakes that I can learn from? And that's why I think building a network around you of really trusted professionals, great buyer's agent, great mortgage broker, great financial advisor, great tax accountant, if you build that great team around you, they're going to deliver heaps of value. And I think this is just another example of that. So I just wanted to mention that as a bit of a sidebar. It's not a sales pitch, but it's really an observation that I've made over the last sort of 25 odd years or so forth. Okay, next, let's talk about how to fund these improvements. Let's talk about the tax consequences and the cash flow consequences. So funding the improvements, wherever possible, I think it's always best to follow the full to borrow the full cost of any improvements, because it gives you the maximum flexibility. Because what it does is it crystallizes the maximum tax deductible loan against the property, and you only get one chance to do that. It's when you first buy the property and when you first pay for the renovations. So be very careful. If you pay with cash, you can't go back and reborrow again. So pay with borrowings. And then if you have cash, you can always put it in a linked offset account so that you're not going to pay for any more interest. So there's no actual cost to it, but you increase the flexibility. And if you first purchasing the property, always try and borrow the maximum initially. If you're going to complete the renovations down the track, you can always have that property revalued. You increase the loan, you put those additional loan funds into redraw. And when it comes time to pay for the renovations, you just redraw the money out and pay the tradie or pay whoever you need to pay. And the benefit of that is that there's a clear audit trail between the redraw and the payment of the expense to make the improvement to the asset, which makes it really clear to the ATO that that additional loan amount is tax deductible because it was used for a tax deductible purpose. There's going to be times where some people needs to put cash into the property. So it could be because of your loan to value ratio that it's so tight that you can't borrow the full cost of the renovations. Look, that might be just something you have to live with. So, I can't say in every single circumstance you should be able to borrow the full cost, but where it's possible, where practical and where economical, absolutely you should fund all renovations through additional borrowings and use the offset account to hold any cash savings that you might have. So let's talk about the tax consequences. So repairs and maintenance are generally tax deductible in the year that you incur the expense. And repairs and maintenance is just returning something to the original condition or the condition it was when you first purchased the asset. In contrast, improvements are treated capital in nature and typically must be depreciated over their useful life. And so capital improvements can include things like replacing the entire structure or asset. So that could be rebuilding a fence or installing a new stove or air conditioner, something like that. It could include upgrading the item beyond its original condition, its condition when you first purchased the property. So renovating our kitchen or bathroom, doing alterations, those sorts of things. Or capital items can include undertaking initial repairs immediately after you purchase the property. Of course, if you're making improvements directly after you're making a repair directly after you purchase the property, of course, that's considered an improvement because the repair needed to happen. You're improving it beyond its original condition. The ATO has a schedule of useful lives, tends to be sort of 5 to 15 years. That's how long, how you depreciate items over. And the link is in the blog on the website as always. And the link to the blog is in the show notes or the comment section as well. Structural improvements, so that's really fixed items. So that's actually the dwelling, the structure itself, fall into what's called capital works. And they're depreciated on a flat line basis at 2.5% per annum. If you do make improvements to a property or renovate, extend, build, whatever it is, you do spend money on a property, it's almost always worthwhile obtaining a depreciation schedule. And so what that involves is that you give all the receipts, everything you've spent on the property to a business that sells these depreciation schedules, and they'll put everything into a table and calculate how much depreciation you can claim each year. And you can hand that over to your accountant, and accountant can include that in your tax return. So they cost about $500 or something of that order, but well worth getting. Of course, the cost of getting a depreciation report is tax deductible as well. Okay, let's talk about the cash flow impacts, because the key thing here is to manufacture equity in the property. So that is that, as I said, if I spend 30 grand on a property, if it's worth 70 or $100,000 more, I'm off to the races. That's a really good outcome from an investment perspective. But the other benefit is that it improves the income profile of the property. You're going to get a higher gross rental income, and then you're going to get a depreciation benefit. And so the rental income combined with the depreciation benefit typically is more than the additional interest you'll need to pay on the higher level of borrowings, because obviously if you borrow to fund those renovations. So it's not uncommon for it to be better off from a cash flow perspective. So it's a great thing, really. It doesn't, your cash flow is improved and the value of your asset is improved. And that's a great situation to be in, because overall it certainly helps investors. So to sum up then, a value add strategy, I think I would employ a value add strategy where my budget was limited, so that I had to make compromises either in terms of location or size of a particular property asset. And particularly if I need to make compromises in terms of location, because if I'm forced to invest into a non-investment grade location, then I can't necessarily hope to enjoy the same uplift in value through a growth cycle as a quality location might enjoy. And therefore, if I'm attacking it from two different angles, both hoping for just general market appreciation, but then also adding value to a property, I'm hopefully going to enjoy a much better shorter term return. So I think people, if your budget is less than say $1 million, I think a value add strategy is going to be something that you need to really think carefully about. But if you've got a budget of $2 million, it's probably less important in that situation. But arguably, maybe everyone should be thinking about a value add strategy, because it is a really good, there's not a lot of downside other than, finding the right people that can manage that project for you. But that's why I say finding a great buyer's agent can help you with that. And I've done it many times myself, and so have clients. And I'm not going to say it's not without any challenges. It's going to take some time, but it's not as difficult as you might initially think. Okay, so for those that are watching this on YouTube, I'm going to leave it there. But for those that are listening on the podcast, I'm going to get into some Q&A in a second. But just before I let you go, over the Christmas New Year period, I've got a series of 4 podcasts They're wealth first principles. So quite often when we think about financial decisions, a lot of people overcomplicate it. I think building wealth is relatively simple. And building wealth tends to be rooted in sort of simple logical principles that are often backed up just with simple mathematics. And so I want to go back to these first principles, partly because I think we always need reminding about these first principles. Also, it will help people that have just joined and just started listening to the podcast to, refresh their memory and just get a good sense of, the fundamentals of investing. And then if you're talking to anyone over the Christmas holiday period that you think would enjoy listening to this podcast, I think this series of 4 podcasts will be a great introduction for them. So if you're making a referral to this podcast, say, look, listen to this first principle series. That's a good starting point. And if it resonates with them, maybe they can continue listening to the podcast. Anyway, my first one's next week, which is Christmas Eve. And it's going to be about really understanding what builds wealth. I'm going to do one on property. I'm going to do one on shares. And the last one's on cash flow. So they're just fundamental sort of principles that I want to get through. And hopefully you enjoy that. And as I said, if you know anyone that will enjoy listening to the podcast, because we often talk to family and friends over that sort of holiday period, please send them my way. Okay, I'll leave it here for YouTube and I'll keep going if you listen to the audio version. Okay, let's get into some Q&A. And the first question is from Nat. Thank you for your intelligent, compassionate podcast, and your common sense attitude inspires me. That's very nice. I think my problem is maximizing income in retirement. I'm 62 years old, single woman, and have made some errors, as you say. Keep digging and make a bigger hole, dig a bigger hole. My current position is as follows. Home is worth $750, no debt. A debt-free unit in Brisbane worth $500,000 that currently rents for $595 a week. Super about $430,000, $45,000. I think it's $45,000. It's not a typo. In some ETFs, which are all fixed interest ETFs, Vanguard fixed interest, both Aussie and global. $31,000 in Technology One shares. It's quoted 400% growth in 5 years, and $75,000 in a term deposit. I did retire and then return to work 4 months later at 3 days per week. I will retire in full on 30 June 26. I earn around $60,000 a year. Should I consolidate, and if so, how? My investments seem like a dog breakfast all over the place and generally not generating enough income. Okay, so what improvements would I make to this financial position? Well, Nat's 62 years old, so can access super if she's not working, and at 65, even if she continues to work. So locking money, in inverted commas, locking money away into super isn't such a big deal. I missed actually that Nat's got a $75,000 term deposit. I should have mentioned that. So locking money away into super isn't that big a deal, and that's really the most cost-effective way for that to be invested. The interesting thing is the mistake here is to think when someone is in Nat's position is to, 1, think too conservatively, or 3, think about maximizing income or really focusing on investment income. The reality is that the better approach is to make sure it's wisely invested, regardless of income, but in order to maximize absolute or total return. So what I'm sort of saying here is, because she's drawing a pension from super, it's for the super fund to kind of manage the asset allocation, not you. You just need to pick an asset allocation that is going to do what you need it to do. And if you're too conservative, your future returns might be 5%. That's not good. Like that, from an inflationary perspective, from a longevity perspective, people living longer, you've got to really make decisions today as if you're going to fund another 40 years, for instance. That's what I would be doing if I was in your shoes, Nat. So you need to really think carefully about that. The good news is that apartments in Brisbane have done really well over the last 2 years. I think will continue to do well right through till 2032 at least. So I wouldn't do anything with the Brisbane unit. I don't know anything about it in terms of, didn't give me an address or anything like that, but I think I would hang on to that. I think that market has just gone through at least up until 2 years ago, a very flat cycle. So I'd hang on to that on the hope that, in 10 years' time, you might be able to sell it for $1 million. And then I'd consolidate everything into super. So you could certainly move the term deposit in there. I'd get rid of all the Vanguard ETFs. You're right. They're actually, Nat made a comment, they're running at a loss for 5 years. They probably haven't lost that much. We're probably talking about a small amount. But the thing is that they're not well invested. Like, they're too conservative, and I'd move it into super. I think about converting your super that's in pension phase back to accumulation. So you can do that. There's no downside to doing that. The downside is that it's not tax free anymore. But I don't think we really care about that. What we want to do is preserve as much money into super and leave it into super. We don't want to be, taking the 4%, the compulsory 4% out each year. So I'd move that back to accumulation. I'd make a non-concessional contribution using the term deposit and ETF. So you're not going to get it all in there because it's 120 a year, but you can make a non-concessional contribution this financial year, and then you can make another one in July. And after you do that one in July, then you can convert it into pension phase and start drawing your pension. And then what you want to hope is that money, which will be maybe 550,000, will last you the next 10 years at least. And then you will sell the Brisbane unit, hopefully for $1 million or something pretty close to it. And you'll be like early 70s by that stage. And hopefully that $1 million will be enough then to fund the rest of your retirement. You can contribute into super up to age 75. So, you've then got a few years. So you might want to actually sell it in 8 years or something so you can try and get that money into super as much as you can. You don't need to get it all in there because you're not going to pay much tax anyway. But that's what I would be doing, is really getting rid of those other assets, which are term deposit and bonds, because they're too conservative and you need to earn better returns on them. So you need more growth in there, and get them into super. So that's not only going to make sure that they're invested in more in growth asset classes, but in an environment that's tax effective and hopefully cost effective, although you haven't told me which super fund you're in. And that's the improvements that I would make having a look at your situation. Okay, I might squeeze one more question in, I should say, from Yana. Appreciate the podcast. Thanks for sharing your knowledge with the Investopoly community. I have a question I've not heard in the podcast before, and it's quite complex to get my head around. We'll try and make it as generic as possible. My husband and I own a 6-acre property in the outskirts of a small town in Tasmania. We've been told that the council will be rezoning our property from rural/farming to residential, and they would like to subdivide the land into town blocks. They estimate that we can fit around 30 blocks on our property. This will not be compulsory acquisition, and they are only at the very early stage of the process. The property is currently our primary place of residence, but was an investment property for 9 months when we were finishing up the renovation on our previous home back in 2021. We feel lucky in making a good purchase here. However, we have no experience in property development in this sort of process, and any advice would be appreciated. Can you please discuss generally what we think we should do to set ourselves up for success? Some questions are: how will CGT be calculated? What taxes should we be aware of? What sort of professional advice do you think we should get before selling? And what would be the what would it be best to sell to a developer or go in partnership with developer? And if we find another house that we would like to move into before it's all finalized, how does that impact CGT? Okay, there's a few moving parts here. Let's deal with the first ones, the obvious ones. So you rented the property for 9 months before you occupied it. That means you will have to apportion the capital gains tax. You only get an apportionate main residence exemption, 9 months versus the whole time that you've owned it, which I think is only about 4 or 5 years. So there'll be some proportionate capital gains tax there. Your property is 6 acres. You can only have 2 hectares, which is just short of 5 acres as a main residence exemption. So not all of your property, and if it's on multiple titles, then it'll just be the title that the dwelling is located on. If it's on one title, you'll probably have to apportion again. So unfortunately, you'll lose a bit of main residence exemption there as well. And then when it comes to capital gains tax consequences, so if you sell just after the rezoning, other than making an adjustment for the 9 months the property's rented out and the size of the property, so 6 versus 5 acres, you shouldn't need to make any other adjustments beyond that. Now, I should say, in all these situations, I'm using the information that's been provided, and sometimes there's idiosyncrasies, complexities and so forth. So this is not advice. Of course, this is very general in nature and just information only, because I might not know everything that I need to know. But from what you've told me, that would seem be the simplest and easiest solution. The process to subdivide blocks and then sell them off is a very complex one. I have a client that has some property in Tasmania that's been looking at working on this for quite some time. It hasn't even got to the stage of, the titles being issued. They're still very early stages, but there's a lot of complexity and sort of pushback. So I know it's not easy, and there's a lot of capital and work involved. So, in terms of putting in facilities before you can sell the blocks, subdividing, building roads, all those sorts of things, which typically are necessary. So I don't think I would recommend really anyone going in as a joint venture owner or as doing some sort of partnership. It's a business. It's not really an investment, and you just want to be careful about the risks. So, I think you're better off to probably get someone to advocate for you, whether it's not going to be a buyer's agent. I don't think they would do that sort of work, but what you really need to do is find someone that is in the commercial property space. And there tends to be a few people like this that sort of freelance, sort of solo, sort of consultant style people. So you need to find one of them. This is what I would do. I'd find one of them, someone that's really good and smart that can go and then negotiate the sale. But it sounds like you're very early stages anyway. So it sounds like you need the council do the rezoning, and then I'd employ that sort of consultant. And maybe they could then join up with an agent, run a sales process and advise you through that process. And whilst you won't capture all the potential upside, at least you're probably capturing most of it without exposing yourself to a lot of risk. And, a joint venture partner might say, oh, well, you've got the land, I'll go and do the development. But then they don't have a lot of skin in the game. Whereas if you sell to someone and they've got to stump up a large amount of cash to buy your land, now they've got skin in the game and they need to make that development work. So that's why I don't really like it, because you're not really sharing the risk, because, okay, they're going to put money into it, but only at the tail end. And I just don't think we all got to be really careful about what are we doing? Is it an investment decision? Is in our wheelhouse? Do we understand the risks? Can we manage this? Do we have the experience? And quite often it's a no to a lot of these questions in this situation. And so I'd be loath to sell to a developer. And the final question that Yana asked was about CGT and for a changeover, if you go and buy another house, it's 6 months. So you can generally claim 2 dwellings for at least 6 months, which makes me think actually the 9-month issue, you might be able to reduce it to 3. And so then your proportion of capital gains tax is going to be lower. But you can claim 2 main residents for if there's a changeover period for up to 6 months. So just let you know that. So, and again, this is all information, not advice, but it is a particular situation or scenario. The only other thing you might do and consider doing is, instead of actually doing the development, is getting a development approval to do the subdivision. But even then, that's going to be challenging. And then with respect to a capital gains tax consequences, that'd be too detailed. I don't know off the top of my head what that would do. I'd imagine it would be market value versus market value. Market value before you had the DA versus market value after, and you'd have to pay capital gains tax on that uplift. But I'm not totally sure. Anyway, it's something that you're going to need to get some advice on. But all the best. Okay, I'm well over time, and I might just leave it there. Until next week. Bye for now. Before we wrap up, I've got a quick request. Apple and Spotify decide whether this show reaches you, and I never want to lose that connection. Email is the only channel I truly own. If you're comfortable, please leave me your email. I will not spam you. Each Wednesday, I'll send you one email with an update of new blogs, episodes, presentations, and videos that I've published. All content. Just visit investopoly.com.au/email to subscribe. Thanks a lot.